Money in the UK. The London Stock Exchange and Ftse Index. One of the world's oldest stock exchanges, the London Stock Exchange, LSE, allows companies from around the world to raise money, increase their profile, and obtain a market valuation through a variety of routes. London Stock Exchange. The center of the UK financial world is the London Stock Exchange, LSE. It is ranked third in the world in terms of market capitalization, the value of the company shares traded on the exchange. It is also one of the most international stock markets, with companies from more than 60 countries represented. Shares make up the bulk of selling activity, but the LSE also sells other types of securities, such as bonds, derivatives, funds, warrants, commodities, and gilts, mainly UK government bonds. Around 2,600 companies are listed with the LSE. These are split between two main sections, the main market for the largest companies, and the alternative investment market, AIM, for small to medium-sized companies. There are also specialized sections, which include the professional securities market, PSM, and specialist market fund, SMF. All of these sections operate as marketplaces. Buyers can purchase investments from companies or institutions that are raising money by selling a stake in their businesses, shares, or offering a return on a temporary debt purchase, debt securities such as bonds. The total value of all the companies trading on the LSE is around £3 trillion. The top 100 companies account for close to 80% of this amount. These are the well-established, top-performing, blue-chip companies that trade on the main market, which is tracked by the Ftse, the Financial Times Stock Exchange 100 Index. The remaining companies trade on the secondary market, AIM, or on the PSM or SMF. Owned by the London Stock Exchange Group, the LSE also offers access to the group's other trading platforms, the Borsa Italiana, Italy's main stock exchange in Milan, MTS, Europe's leading fixed income market that trades mostly government bonds, and Turquoise, a pan-European multilateral trading facility that trades securities from 19 different European countries. Main market. Before it can be listed on the LSE's main market, a company must be valued at £700,000 or more. It must also provide at least 3 years' worth of audited accounting statements that have been prepared in accordance with International Finance Reporting Standards, IFRS. The main market comprises a number of sections, each of which has its own requirements for listing and an index for tracking ups and downs in trading. Ftse 100. The best-known index of the LSE is the Financial Times Stock Exchange, Ftse 100 Index. Nicknamed the Ftse, the index tracks the sale of shares from the top 100 blue-chip companies listed on the LSE, including BP, Rio Tinto, Tesco, and RBS. It is recalculated every 15 seconds to indicate live trading volumes and track performance minute by minute. The companies in the top 100 are reviewed and adjusted every quarter to make room for new top performers. Ftse 250. The Ftse 250 lists the LSE's 250 next most valuable companies, following the Ftse 100 companies, ranking them from 101 to 350. Ftse 350. The Ftse 350 lists the top 350 companies in the UK and is a combination of the Ftse 100 and the Ftse 250. Ftse Small Cap. The Ftse Small Cap companies, the next tier down from Ftse 350 companies, are ranked by their worth from 351 to 619. The name Small Cap alludes to the fact that these firms have smaller capitalization than those of the Ftse 350. Ftse All Share. A combination of the Ftse 100, 250, and Small Cap, the Ftse All Share Index gives a broader overview of how public companies on the LSE are performing. Ftse Fledgling. The Ftse Fledgling Index comprises around 200 companies that are smaller than those on the Ftse All-Share, but still qualify for a listing on the main market. Alternative Investment Market. The Alternative Investment Market, AIM, is designed for companies that issue shares and sell them on the LSE, but find it hard to meet the main market's strict regulations. In AIM rules, for example, unlike in main market rules, there are no requirements for companies to be of a minimum size or have an established trading record. This makes it possible for companies that are at an earlier stage of their business development to join the public markets. Also referred to as the junior market, AIM was launched in 1995 to give these smaller companies the opportunity to raise money from investors. There are around 1,450 companies listed on AIM, and they are divided into 3 categories. Ftse AIM UK 50 Index, the top 50 UK companies. Ftse AIM 100 Index, the top 100 companies. Ftse AIM All-Share Index, all the companies listed on AIM. Regulation. Activities on the LSE are regulated by a branch of the Financial Services Authority, FSA, called the UK Listing Authority, UKLA. Any company that applies for listing on the LSE has to go through the UKLA for approval and must meet certain eligibility criteria. Requirements differ depending on what type of listing a company wishes to have. The more elevated the listing, with the main market at the top, the more stringent the UKLA's eligibility review process. Hedge funds. Hedge funds are an investment option that can offer potentially huge returns, although they are also high risk. A hedge fund puts money into a wide variety of financial products, including shares, bonds, and a more complex category of assets called derivatives, options, warrants, futures, and swaps, for example. Anything that the fund manager anticipates will turn a profit is a potential target, regardless of the current economic situation. There are few controls over the types of investments a hedge fund manager can make, which means they are high risk. Where other types of investments try to outperform a particular index, such as the Ftse, hedge funds are designed with the aim of simply producing a profit. This means that investors rely solely on the skill of the hedge fund manager in deciding on an investment strategy and choosing the most lucrative mix of financial products. Fund manager fees are usually around 2%, plus an additional 20% performance fee. Until recently, hedge funds were reserved for the super rich or financial institutions, since millions were required as the minimum spend. However, private investors in the UK with more modest budgets can now put their money into a fund of funds, which pulls money from numerous investors and spreads it across several hedge funds in order to minimize risk. In the UK, the marketing of these funds is restricted to protect small private investors, and there is little recourse if things go wrong, unless the manager is registered with the FCA. Companies House and Corporate Accounting. Companies House, an agency sponsored by the Department of Business, Energy, and Industrial Strategy, incorporates and dissolves limited companies, registers companies' information, and makes this available to the public. Company registration. Any company that does business in the UK has legal obligations. If it has a physical place of business in the UK, whether it is an enterprise founded in the UK or is from overseas, one of its first obligations is to register with Companies House. Overseas companies must register within 1 month of opening a place of business in the UK, but some types of overseas enterprises, such as partnerships, limited partnerships, or government agencies, cannot register in the UK. In order to register, businesses must complete a registration form and pay a small standard fee. Some overseas businesses may also have to provide copies of their incorporation documents as well as their most recent set of accounts. Once registered, companies are expected to submit an annual tax return to Companies House. They must also submit quarterly statements and an annual return to Her Majesty's Revenue and Customs, HMRC, and pay corporation tax annually on profits up to £1.5 million, and in installments on profits above £1.5 million. 3 types of enterprises must pay corporation tax on their profits: UK companies, overseas companies registered in the UK, and clubs, cooperatives, and other types of associations such as community groups or sporting clubs. Partnerships do not register with Companies House and are not obliged to submit accounts to HMRC, other than the personal income tax returns of the individuals in the partnership. UK accounting standards. Both Companies House and HMRC require financial statements to be prepared in a format that complies with official UK accounting standards, which means that specific items and types of calculations must be included in the accounts. The standards are issued by the Financial Reporting Council, FRC, and the UK Generally Accepted Accounting Practice, UK GAAP, is the body of regulations that have been established over time, stipulating how UK company accounts must be prepared and reported. It includes accounting standards as well as UK company law. The accounting framework is made up of 6 different standards, FRS 100 to FRS 105, each of which sets out the reporting standards required for the different kinds of companies in the UK. For instance, as parent companies, unlisted companies, and insurers. Company accounts need to be submitted to both HMRC and to Companies House at the end of the financial year. The accounting year begins on the 1st of June and finishes on the 31st of May, but these dates can differ in a company's first year, since a company begins its first accounting period from the day it is incorporated, not the day it starts trading. Companies do not have to use an accountant to prepare accounts, but directors are legally obliged to ensure that financial statements adhere to the guidelines issued by the FRC. Private companies are obliged to hold their accounting records for 3 years, whereas public companies must keep them for 6 years. Fraud prevention. From 2017, the law on tax evasion will include the new corporate offense of failure to prevent the facilitation of tax evasion, both in the UK and overseas. This means that anyone who turns a blind eye to tax evasion for an employer, or who is in any way involved in the evasion process while acting for a corporation, is liable to be prosecuted. The law is aimed at anyone representing an organization, such as an employee or accounting agent, as well as at individual taxpayers. Intellectual property law. Companies doing business in the UK can apply to the Intellectual Property Office, IPO, to register intellectual property. Intellectual property includes trademarks such as product names, jingles, and logos, registered designs, that is, the appearance of a product including its packaging, pattern, and shape, and patents, which are applicable to inventions and products such as machines and medicines. Copyright of written works, films, photography, music, web content, and sound recordings are automatically covered under UK law, as are design rights, which refer to the shape of objects and how their different parts are arranged together. After the UK withdraws from the European Union, UK companies will still be able to register an EU trademark or a design, and UK businesses will still be able to apply to the European Patent Office for protection. Companies that have made an international patent application can apply to have this registered in the UK as well, so long as application is made within 31 months of the international application. Corporation tax rates. The main rate of corporation tax was set at 20% until 2016, but in the budget of 2016, the government announced that the rate would change to 19% for the tax years beginning 1st of April of 2017, 2018, and 2019, and that on the 1st of April 2020, it would drop to 17%. This rate applies to all companies except for those that profit from oil extraction or oil rights in the UK, known as ring-fence companies. Tax submission. The accounting year. Each year, limited companies must submit annual accounts to Companies House and a company tax return to HMRC. For new companies, the first accounting year starts at the end of the first month of incorporation. This is called the Accounting Reference Date, ARD. The deadline for filing accounts is 21 months after the ARD for private companies and 18 months after the ARD for public limited companies, PLCs. Deadlines for filing. Action. Filing first accounts with Companies House. Deadline. 21 months after registration with Companies House. Action. Filing annual accounts with Companies House. Deadline. 9 months after the company's financial year ends. Action. Paying corporation tax or informing HMRC that the limited company doesn't owe any corporation tax. Deadline. 9 months and 1 day after the company's accounting period for corporation tax ends. Action. Filing a company tax return. Deadline. 12 months after the company's accounting period for corporation tax ends. The Bank of England and the UK economy. The Bank of England acts as a banker to the government, as well as to commercial banks. The bank issues banknotes, sets the base interest rate, and regulates the banking system, influencing the UK's economy. The UK's central bank. The Bank of England, BOE, was established in 1694, making it the second oldest central bank in the world, after Sweden's Riksbank. Since June 1998, the Bank of England has been fully independent from the UK government. Following the 1997 election that brought Labour to power, the then Chancellor Gordon Brown initiated the Bank of England Act 1998 to give the Bank of England operational independence over monetary policy. The bank serves as the banker for commercial banks in the UK and acts as a lender of last resort. It also maintains the government's bank account, the Consolidated Fund. Aside from acting as banker to the government, the Bank of England has 3 primary roles: issuing banknotes, setting the base interest rate, and regulating the banking system. In its first 2 roles, the Bank of England aims to maintain stable prices throughout the UK economy and confidence in the UK currency, known as the pound, or sterling. It makes vital decisions over both the supply of money and the base interest rate that is charged on loans to commercial banks, and which is payable on their deposits with the central bank. In turn, these functions contribute to movements in the exchange rate, pushing the sterling higher or lower against the currency of other countries. By manipulating the money supply, the Bank of England has the power to directly influence the economic course of the UK. Foreign currency. The Bank of England is also responsible for managing gold reserves in foreign exchange for Her Majesty's Treasury, HMT. The UK stock of foreign currency is held in a government account for HMT. The Bank of England acts as HMT's agent, buying and selling foreign currency and investing some of it within limits set by HMT. These reserves can be used in part to guard against large fluctuations in the pound sterling. For example, in the 12 months leading up to the 2016 Brexit vote to leave the European Union, the Bank of England increased its foreign currency reserves by 34%. Economists saw this move as a precautionary measure to protect sterling from being devalued too much in the uncertainty following the Brexit decision. Banknote printing and security. In England, sterling notes are printed solely by the Bank of England, but in Scotland and Northern Ireland, 7 other banks have a license to print local currency with permission from the Bank of England. 3 are based in Scotland and 4 in Northern Ireland. The Bank of England issues banknotes in denominations of £50, £20, £10, and £5 for circulation in England and Wales. Scotland and Northern Ireland also issue £100 notes, but only Scotland issues a £1 note. Banknotes issued by Northern Ireland and Scotland can be used anywhere in the UK, but only if the trader agrees to accept them. Likewise, banknotes issued by the Bank of England can be used outside England and Wales if both parties conducting the transaction are in agreement. In other words, Bank of England banknotes are only legal tender in England and Wales, while banknotes issued in Scotland and Northern Ireland are only legal tender in their respective regions. Interest rates. Before making decisions about raising, dropping, or maintaining interest rates, the Bank of England assesses current economic data, such as the rate of unemployment, the growth of gross domestic product, GDP, and inflation. The bank also collects data from around the UK through its 12 agencies stationed in Scotland, Northern Ireland, Wales, and the regions of England. These agencies act as the bank's eyes and ears, gathering information on business conditions across the United Kingdom. Interest rate decisions are made by the bank's Monetary Policy Committee, MPC, and these are announced on a monthly basis, always at 12 noon on a Thursday. The MPC also releases forecasts on inflation and growth in its Inflation Report, published 4 times a year in February, May, August, and November. These projections form the basis for decisions concerning interest rate changes. If the economy is sluggish, the Bank of England will lower interest rates to encourage spending and to stimulate the economy. If the economy is in danger of growing too rapidly, potentially resulting in higher inflation, the Bank of England will increase interest rates to make borrowing more expensive and dampen spending activity. As part of its decision-making, the bank must also factor in the government's stated aim of limiting inflation to 2%. Quantitative easing. When officially lowering the interest rate is still not enough to stimulate growth in the economy, the Bank of England can implement a monetary policy called quantitative easing, QE, to further influence interest rates. In quantitative easing, the bank creates new money electronically, rather than printing banknotes, and uses it to buy government bonds. This has the effect of raising the price of government bonds, which reduces the yield or interest rate payable to investors. Reduced interest rates encourage businesses to borrow more. They, in turn, spend more and employ more staff, thereby boosting the economy. Bank of England activity. Introduction of Polymer notes. In September 2016, the Bank of England introduced a £5 polymer note, printed on thin plastic film, marking the beginning of the end of paper banknotes in the UK. The old paper £5 ceases to be legal tender on the 5th of May 2017. New £10 and £20 polymer notes are both due for release in England and Wales by 2020. The 3 Scottish issuing banks will also print their new notes on polymer. Because polymer has greater durability, as well as more resistance to moisture and dirt, notes will last up to 2.5 times longer. They can also be printed with transparent windows in the design, which makes them more difficult to counterfeit. After Brexit. To stimulate the economy in the wake of Brexit, the Bank of England took the unprecedented measure of launching a scheme to buy company bonds as of the 27th of September 2016. With a budget of up to $10 billion, the corporate bond buying program is intended to drive down borrowing costs, encouraging businesses to invest, thereby boosting employment and economic growth. The UK tax system. Responsibility for UK taxation is shared across 3 different bodies: the central government in Westminster, local government, and devolved national governments. Role of government. Central government collects both direct taxes, such as income tax, and indirect taxes, such as VAT. Local governments collect business rates and council tax. The devolved national governments of Scotland, Wales, and Northern Ireland have some powers to set their own tax rates, especially business rates and land tax. Scotland has the additional power to set land and business transaction tax and landfill tax, which are collected by Revenue Scotland. From 2018, Wales also has the power to set land transactions tax and landfill tax, with the Welsh Revenue Authority being set up to deal with these taxes. Only Scotland has its own rate of income tax, although this is collected by the central government. Northern Ireland is now free to set up its own rate of corporation tax. The central government, based in Westminster, provides funding to local councils and the devolved national governments, and also earns revenue through many streams. These are managed by 2 primary financial bodies: Her Majesty's Treasury, HMT, and Her Majesty's Revenue and Customs, HMRC. While HMT is responsible for overseeing the tax system, HMRC is responsible for collecting taxes nationwide and fairly administering the tax system. HMRC was set up by the Treasury in 2005 as a non-ministerial government department, a merger between Inland Revenue, the government department responsible for the collection of direct taxes such as income tax, and Her Majesty's Customs and Excise, which collected indirect taxes such as VAT. Revenue sources. HMRC now collects most of the tax that comes into the UK government coffers. The majority of revenue comes in the form of direct taxes, which are applied to income, profits, and other proceeds such as inheritance tax. These are either deducted at source, for example, through the pay-as-you-earn PAYE system, which deducts tax from an employee's salary every month, or are payable to HMRC, such as corporation tax. Income tax and national insurance contributions are the main direct taxes, around 45%. Other direct taxes include capital gains tax, inheritance tax, and corporation tax. Income tax is by far the most important source of revenue for the government. Over the past decade, the amount of revenue coming in from high-income taxpayers has increased, and the amount coming in from lower-income taxpayers has decreased, following changes in government policy. The personal allowance for lower-income taxpayers has increased, while the threshold for higher-income taxpayers has reduced. As a result, the number of higher-rate taxpayers has increased by over 1 million. Indirect tax revenue is also collected by HMRC. These taxes are paid by consumers when they purchase products and services. It is then the seller's responsibility to pay the tax to HMRC. VAT is the main indirect tax, making up around 18% of government revenue. When added together with other indirect taxes, charges on goods and services comprise 28% of revenue. Council revenue. At a local level, councils rely primarily on council tax and business rates for their revenue. They are allowed to raise council tax by a limited amount, a limit that is set by the national government. Councils have the power to increase business rates in line with the Retail Price Index, RPI, which measures changes in the price of a shopping basket of retail goods and services. This basket includes a wide range of items that consumers might regularly pay for, such as food, gas bills, child-minding fees, and football tickets. The RPI is officially known as the RPIJ. The J refers to the way in which the index is calculated, according to a method known as Jevons. This index is calculated every year, and the government then uses it to assess other types of taxation, such as tax allowances and state pensions. If the RPI increases, for example, the government will have to consider increasing pension payments to compensate for the higher cost of living. Tax collection. HMRC's tax collection powers have significantly increased since 2005. It now has the power to obtain contact information for defaulting taxpayers through a third party. It can also petition the courts to put a company into liquidation and request security against the possibility of future bad debts if a company has previously failed to meet its tax obligations. Since the 6th of April 2016, HMRC has been able to recover debts directly from a taxpayer's account, provided that the debt is more than £1,000 and that HMRC leaves a minimum of £5,000 in the debtor's account. HMRC can only do this if they have first followed a strict protocol that includes a face-to-face meeting with the taxpayer, discussion of manageable repayment options, and offering support to debtors who are considered to be vulnerable. Tax revenue. UK tax revenue. Income tax, 27%. National insurance, 18%. VAT, 18%. Corporation tax, 7%. Other taxes, 6%. Other indirect taxes, 6%. Business rates, 5%. Council tax, 5%. Capital taxes, 4%. Fuel duty, 4%. The vast majority of tax revenue comes from income tax and national insurance contributions, while tax from corporations and other business tax is small by comparison. The tax gap. Every year, a substantial portion of the tax that is payable to HMRC is not collected. For example, the tax gap for 2013 to 2014 was around £34 billion, or 6.4% of the total tax bill, according to HMRC statistics. This is 2% less than the tax bill for 2005 to 2006. The decrease is mainly due to new measures giving HMRC more power and resources to decrease tax evasion and encourage individuals and businesses to declare accurately and pay voluntarily. Government figures show that in 2014 to 2015, HMRC collected £517.7 billion in tax revenue, including £26.6 billion that would have been otherwise lost due to evasion. National insurance and indirect taxes. In the UK, government pension schemes are funded by national insurance contributions. Revenue is also collected through charges on products as VAT, duties on certain items, and other indirect taxes. Revenue from national insurance. Money the government receives in national insurance, NI, contributions, is used exclusively for paying out state pensions. Essentially, this year's NI revenue pays for this year's pension requirements. NI contributions go directly into a dedicated fund and are kept separate from any other tax revenue. Unlike some other nations, such as the USA, United Arab Emirates, and Norway, the UK does not have a sovereign wealth fund, which is a state-owned investment fund that can be used for pensions, amongst other things. This means that the UK government does not buy shares or invest money on behalf of the nation. For example, the government could have invested earnings from tax on North Sea oil during the 1970s and 1980s, buying government bonds and substantially increasing its fund. However, this money was instead used to fund tax cuts and public spending, and the UK's current budget deficit makes it unlikely that a sovereign wealth fund could be established now. Although there is no sovereign wealth fund, the UK government does invest NI contributions in its call notice deposit account, which is managed by the Debt Management Office. The money is placed in an overnight account and held on loan to earn interest at the going rate. The amount in the account is adjusted day to day so that the government can take funds out when they are needed for pension payments. There are no restrictions on withdrawals of the fund, and as a consequence, the interest that is earned is low, contributing only a small additional amount to the NI fund. Since the 1990s, the NI pool has been in surplus. That is, more money has been coming in from NI payments than going out in the form of pension payments. However, the surplus has begun to dwindle because there has been a fall in earnings growth. The financial crisis of 2007 to 2008 triggered a decline in real wages of more than 10% in the 9 years up to 2016. Figures for real wages are adjusted for inflation so that they accurately measure spending power, the amount of goods and services that can be bought with an average monthly pay packet. Until real wages begin to recover, the NI surplus will continue to diminish, as employers and workers are paying in less money. Some government predictions forecast that if this trend persists, the fund will be exhausted by 2035 to 2036. Partly in response to this challenge, the government introduced a new state pension in 2016 and is now gradually increasing the age of retirement. For anyone retiring after 2021, there will be a flat rate of pension between £145 and £155 per week. To be eligible, the pensioner must have paid NI contributions for 35 years. Rises in the state pension are calculated according to a triple lock, with the payment rising by the same rate as inflation, average earnings, or 2.5%, whichever is the highest. VAT. Value-added tax, VAT, makes up around 18% of government revenue, vying with national insurance contributions as a second largest component after income tax. VAT is paid on all sales in the UK. It is the responsibility of vendors to pay VAT they have received to the government, minus any VAT they have paid. businesses must register for VAT if turnover is more than £83,000 in a 12-month period. The standard rate of VAT is 20%, which is added to the majority of goods and services. This rate has been in place since January 2011, increased from 17.5%. A reduced rate of 5% is applied to some products, including children's car seats, sanitary products, and domestic gas and electricity. A huge variety of items are rated 0, including basic foods, books, newspapers and magazines, children's clothing and shoes, energy-saving measures installed in homes, and public transport fares. Within VAT regulations, there are a few quirks. Cold takeaway food is 0 rated, for example, but any takeaway food that is sold hot and eaten while hot, such as pies, toasted sandwiches, pizza, and soup, is rated at the standard 20%. Potato chips are standard rated, but maize and corn snacks, such as tortilla chips, are 0 rated. In a famous court ruling in 1991, McVitie's Jaffa Cakes were deemed to be cakes, which are 0 rated for VAT, rather than chocolate-covered biscuits, which are taxed at the standard rate. Other indirect taxes. A raft of other indirect taxes contribute to revenues, such as fuel duty, duties on tobacco and alcohol, stamp duty and land tax, capital gains tax, inheritance tax, customs duty, landfill tax, betting and gambling tax, and insurance premium tax, IPT, which is applied to purchases of insurance policies and increased from 6% to 10% in 2017. Additional smaller taxes have been introduced since 2010, in part to compensate for reduced revenue from corporation tax, as the rate is set to fall from a previous rate of 20% to 17% by 2020-2021. In 2011, a new bank levy came into effect, penalizing large banks for excessive liabilities on their balance sheets. A surcharge on bank profits was introduced in 2016, meaning that banks pay an additional 8% on top of corporation tax on their profits and are now a larger source of revenue than before. Other new taxes have social aims as well as generating revenue. For example, a soft drinks levy will not only generate revenue, but also tackle the health risks associated with high sugar intake. Government spending. How revenue is spent. Social protection, £222 billion. Health, £140 billion. Education, £98 billion. Other, £53 billion. Debt interest, £53 billion. Defense, £38 billion. Public order and safety, £32 billion. Personal social services, £31 billion. Housing and environment, £25 billion. Transport, £23 billion. Industry, agriculture, and employment, £17 billion. Revenue received by the UK government through indirect tax and direct tax is used to fund public spending. The major share of government revenue goes to meeting social security obligations, including the state pension, public sector pensions, housing benefits, and unemployment. The next largest spend is on public health, followed by education. Personal tax. Any UK resident who pays into a savings account, buys shares, or invests in other financial products is subject to tax on income from these activities. Exemptions are made for some groups, such as low earners and minors. Tax on savings. In April 2016, a new personal savings allowance was put in place, meaning that account holders earn some tax-free income from interest on their savings. Prior to April 2016, building societies and banks deducted the tax at source and paid the interest net. Interest is now paid gross without any tax deducted. If your total taxable income is £17,000, you will not pay any tax on savings income. Above that, basic rate taxpayers can earn £1,000. Higher rate taxpayers can earn £500, while additional rate taxpayers the highest band, have no personal savings allowance and must pay tax on their interest. Income earned from tax-free accounts, such as individual savings accounts, ISAs, and some national savings and investment accounts, do not count towards the allowance. Different rules apply to children's accounts and foreign accounts. Although interest is usually tax-free on children's accounts, if the child's account earns over £100 in interest from money paid in by a parent, the parent will have to pay tax on the interest if it exceeds their personal allowance. An exception to this rule is if the interest is earned on money given by grandparents, relatives, or friends, or on money in a junior individual savings account, ISA, or child trust fund. Money saved in a junior ISA account is tax-free up to a limit of £4,080. In the case of a cash ISA, there is no tax on interest earned. For an ISA invested in stocks and shares, there is no tax payable on any dividends or capital growth. These types of accounts are available to anyone under the age of 18 living in the UK. Junior ISAs have now replaced child trust funds. The child trust fund scheme is now closed, and no further accounts can be opened, but existing ones still benefit from tax-free savings of up to £4,080. Tax breaks on investments. Income earned from investments is treated like any other income, with the exception of individual savings accounts, ISAs, in which an amount of £15,240 can be saved tax-free in any single tax year. This money can be deposited into one of three types of ISAs: cash, stocks and shares, or innovative finance. Investors can put it all into one type of ISA, or split the total tax-free allowance across two or three types of ISAs. As with junior ISAs, there is no tax to pay on interest earned in a cash ISA, nor on dividends or capital growth from stocks and shares, or an innovative finance ISA. Innovative finance ISAs include relatively new types of investments, such as peer-to-peer loans. Other alternative investments are also accompanied by tax breaks. Investors in forestry land, for example, will pay no income tax, capital gains tax, or inheritance tax if they hold on to the forest for a minimum of 2 years. Inheritance tax. In the 2015 budget, the UK Chancellor announced changes to inheritance tax, Iht, that effectively increased the threshold for both single people and married couples. From April 2020, next of kin who inherit property will only have to pay inheritance tax if the property is worth more than £500,000. If inheriting from a married couple or from civil partners, this figure increases to £1 million. The main change to the tax is the introduction of a family home allowance worth £175,000 per person, which, added to the existing allowance of £375,000, makes up the new £500,000 threshold. Once the threshold is exceeded, an IHT rate of 40% is applied. This can be reduced to 36% if 10% or more of the estate's net value is willed to charity. Any tax owing is paid directly from the estate to HMRC by the executor of the will. As an incentive to those with large houses and grown children that have left home, the government offers an inheritance tax credit to property owners who sell and trade down to smaller properties, as long as the bulk of their estate is left to their descendants. If the deceased passes on the family home to a spouse, no inheritance tax is due. A 7-year rule applies to any gifts of more than £3,000 per year given to direct descendants. If the deceased dies within 7 years of making the gift, a sliding tax rate applies based on the number of years that have passed since the gift was made. Tax on digital currencies. The UK government is still developing a full policy on the regulation of Bitcoin and other digital currencies. Up until March 2014, VAT of 20% was applied to Bitcoin purchases, but it is now treated as personal money like any other currency. That means that no VAT is payable when Bitcoin is exchanged for sterling or other currencies. However, if goods or services are being provided with payment made in Bitcoin, VAT is applied as usual if the provider is VAT registered. Profit and loss on any capital gains made from buying and selling Bitcoin is taxable like any other capital gain. Income earned in Bitcoin is taxed at the usual rate for income and corporation tax. Several online cryptocurrency exchanges operate from the UK, offering a virtual marketplace for buying and selling Bitcoin. Bitcoin can be bought or sold with sterling or other key currencies, and some exchanges allow the purchase of digital currency with a debit or credit card. Bitcoin is traded on virtual exchanges, as well as some international stock exchanges, which means investors can treat it as they would any other currency, buying Bitcoin in sterling, for example, and exchanging it later when the value of Bitcoin is up against the pound. Inheritance tax, IHT, rates. Changes in inheritance tax thresholds take effect from April 2020. Different rates will apply to single people and married people or civil partners. Single person. Value of other assets, £175,000. Value of family home, £175,000. Value of the estate, £350,000. IHT liability as of April 2020, nil. Value of other assets, £200,000. Value of family home, £300,000. Value of the estate, £500,000. IHT liability as of April 2020, nil. Value of other assets, £250,000. Value of family home, £400,000. Value of the estate, £600,000. IHT liability as of April 2020, £60,000. Value of other assets, £400,000. Value of family home, £600,000. Value of the estate, £1 million. IHT liability as of April 2020, £200,000. Value of other assets, £750,000. Value of family home, £750,000. Value of the estate, £1,500,000. IHT liability as of April 2020, £400,000. Value of other assets, £1 million. Value of family home, £1 million. Value of the estate, £2 million. IHT liability as of April 2020, £600,000. Married person. Value of other assets, £175,000. Value of family home, £175,000. Value of the estate, £350,000. IHT liability as of April 2020, nil. Value of other assets, £200,000. Value of family home, £300,000. Value of the estate, £500,000. IHT liability as of April 2020, nil. Value of other assets, £250,000. Value of family home, £400,000. Value of the estate, £650,000. IHT liability as of April 2020, nil. Value of other assets, £400,000. Value of family home, £600,000. Value of the estate, £1 million. IHT liability as of April 2020, nil. Value of other assets, £750,000. Value of family home, £750,000. Value of the estate, £1,500,000. IHT liability as of April 2020, £200,000. Value of other assets, £1 million. Value of family home, £1 million. Value of the estate, £2 million. IHT liability as of April 2020, £400,000. Mortgages and credit cards. The UK's mortgage and credit card markets are among the most developed in the world. A huge range of mortgages are available to the prospective house buyer, and more credit cards are in use in the UK than anywhere in Europe. Mortgages. The UK has one of the most diverse mortgage markets in the world, with a wider range of products than in most countries. Around 300 lenders comprise banks, building societies, specialized mortgage organizations, insurance companies, and pension funds. There are 3 types of mortgages in the UK. A fixed-rate mortgage is the most popular, as the interest is set at the same level for 2, 3, 5, or even 10 years, allowing borrowers to plan their repayments. A tracker rate mortgage is fixed to the base rate set by the Bank of England, while a variable rate can change at the discretion of the mortgage's lender. The Mortgage Market Review. A borrower's eligibility for a mortgage is currently determined by the Mortgage Market Review rules introduced by the Financial Conduct Authority, FCA, in April 2014. This has made it more difficult to be approved by a lender. The lender now takes into account not only the applicant's declared income, but also their outgoings, what remains after the regular monthly expenditure, verified by their bank statements. Lenders also have to consider whether the prospective buyer will be able to meet repayments if interest rates rise, typically calculating potential increases at a rate of between 6% and 7%. Mortgage trends. The 25-year mortgage, once the housing market's mainstay, is now rivaled by the 30-year mortgage, according to data from the Office of National Statistics. From 2006 to 2015, the 25-year mortgage's share of the entire UK market fell from 42.2% to 21.5%. Meanwhile, over the same period, the 30-year mortgage grew in market share from 7.2% to 19.1%. This longer-term mortgage makes the monthly repayments more affordable, especially for first-time buyers. In fact, almost a third of first-time buyers now opt for a term of 35 years. Minimum deposits for mortgages start at 5%, but most buyers aim for a higher deposit, as this gives access to better lending rates with lower repayments. In the UK, the average deposit as a proportion of the loan is now around 30%, or just over £70,000. Buy-to-let. The introduction of buy-to-let mortgages in the late 1990s stimulated huge growth in the number of investor landlords who bought multiple properties, vying for first-time buyers for properties in areas of urban growth and driving up prices. In 2015, buy-to-let accounted for 9% of all property purchases in the UK. To dampen investor enthusiasm in favor of first-time buyers, the government introduced higher stamp duty on buy-to-let properties. Most buy-to-let mortgages require a minimum deposit of 25%. Incentive schemes. The government's Help to Buy mortgage scheme, which helped first-time buyers obtain a bigger deposit, closed at the end of 2016. Other measures were put in place, aimed at stimulating a housing market in which the level of house prices relative to earnings has been high, making it especially hard for first-time buyers to get onto the property ladder. Under the Right to Buy scheme, council and housing association tenants living at their homes for a minimum of 3 years may be eligible to buy them, with discounts of up to £103,900 in Greater London and £77,900 outside London. First-time buyers in the private sector can open a Help to Buy ISA account to build up a deposit. For every £1 saved into the account, the government will boost it by 25%, up to a maximum of £3,000. In England, the government's Starter Homes initiative aims to help first-time buyers under 40 years of age to purchase a new home, offering a minimum discount of 20% off the market price. Under the scheme, the maximum cost of a new home outside London will be £250,000, with an upper limit of £450,000 inside London. Credit card regulations. The UK has the most developed credit card market in Europe, with more credit cards in use and more transactions per person than anywhere else in the European region. There are more than 60 million credit cards in circulation in the UK, tied to 51 million accounts. Around 42% of credit card accounts have balances that are accruing 0% interest, since the balances are paid off every month. Interest on accounts that are not paid in full is calculated in one of two ways: average daily balance or daily balance. Both methods arrive at the same result by calculating interest owing on a daily basis, based on the day-to-day balance showing on the credit card. Credit card companies usually charge interest on credit cards as soon as a purchase is made. However, As long as the balance is paid in full each month, most cards offer an interest-free period, the time between the purchase date and statement date, and/or the time between the statement date and payment due date. The Consumer Credit Act 1974 governs credit cards in the UK. This legislation offers several safeguards for consumers, including a 5-day cooling-off period. Section 75 of the Act gives consumers protection for card purchases between £100 and £30,000 in the case of a breach of contract or misrepresentation by the seller. If the consumer cannot get a refund from the retailer, then the law holds the credit card company liable, and they must then issue the refund. Stamp duty. Regional stamp duty charges. Stamp duty land tax, SLDT, is payable on purchases of land or property in England, Wales, and Northern Ireland. The tax applies to purchases above £125,000 for residential property and land and £150,000 for non-residential land and property. Different rates apply to second property purchases or buy-to-let. Tax on residential property purchases in England, Wales, and Northern Ireland. Property or lease premium or transfer value. Up to £125,000. SDLT rate, 0%. The next £125,000 from £125,001 to £250,000. SDLT rate, 2%. The next £675,000 from £250,001 to £925,000. SDLT rate, 5%. The next £575,000 from £925,001 to £1.5 million. SDLT rate, 10%. The remaining amount, portion above £1.5 million. SDLT rate, 12%. In Scotland, the equivalent of SDLT is Land and Building Transaction Tax, LBTT, which came into effect from the 1st of April 2015. The rate percentages are the same as for the rest of the UK, but the band thresholds are different. Tax on residential property purchases, Scotland. Purchase price, up to £145,000, LBTT rate, 0%. Above £145,000 to £250,000, LBTT rate, 2%. Above £250,000 to £325,000, LBTT rate, 5%. Above £325,000 to £750,000, LBTT rate, 10%. Over £750,000, LBTT rate, 12%. Pensions. The UK government offers a pension to UK citizens who have made sufficient contributions towards their national insurance during their working lives. Private pension options are available, sometimes augmented by employers. The new state pension. A new UK pension system was introduced in April 2016, the new state pension, with a maximum weekly payout of £155.65. This only applies to those who reached retirement age on or after the 6th of April 2016. Existing retirees were not affected and continue to receive the old state pension, comprising of a basic payment of £119.30, plus an average of £40 for those who paid into the second state pension, also known as the State Earnings Related Pension, or SERPS. To receive the minimum level of new state pension, pensioners will need to have paid national insurance contributions for 10 years. In order to receive the full state pension of £155.65, contributors will need to have paid in for 35 years. Those who have not paid in for this length of time will receive a pro rata amount based on the number of years they have paid in, as long as they meet the 10-year minimum requirement. This figure is calculated by multiplying the number of years that contributions were made by £4.45, £155.65, divided by 35 years. National insurance. National insurance contributions are payable when earnings exceed £155 a week. Income tax and national insurance contributions are automatically deducted and paid to HMRC by employers, but the self-employed are responsible for paying in their own. Any gaps in national insurance can be topped up in order to meet the minimum requirement, and those who have been unable to work due to illness, disability, unemployment, or being a carer can apply for national insurance credits. Usually, a 6-year time limit is imposed for top-ups to any tax year. For example, the deadline for top-ups for the tax year 2015 to 2016 is 2022. The 2016 changes to the state pension also affect the age of retirement and the options for accessing pension pots once retirees are eligible. Women reach retirement age later than previously. In 2018, the pension age for women will be 65, in line with the retirement age for men. By 2020, the retirement age for both sexes will rise to 66, and then to 67 by 2028. When it comes to private pensions, including employer schemes, retirees will have more flexibility as to what money can be spent on. Until April 2015, retirees could take their pension pot as a lump sum and use it to buy an annuity. A life insurance company is given the pension and pays out a regular monthly income. Under new rules, that pension pot can be used for a lump sum withdrawal instead of spent on an annuity. The downside of an annuity is that when a retiree dies, the annuity dies with them. The upside is guaranteed income for life. On the other hand, a lump sum drawdown allows retirees to leave some money behind for loved ones after their deaths, and the rest of the money can be used for investment or pleasure. Private pensions. The government encourages workers to pay into a private pension fund by offering tax incentives. Contributions to private pension schemes are usually tax-free up to a certain limit, and this applies to most schemes. In the UK, there are two main private pension categories: workplace pensions, where employers pay in as part of an employee's salary package, and private pensions that employees pay into, which may be offered via the workplace. In private pension schemes, a contract is made directly with the insurance provider, whereas with a workplace pension, the employer sets up the insurance contract and pays in on the employee's behalf. If the employee leaves their job, they can transfer the accrued funds to a new scheme or continue paying into the workplace scheme, even though they are no longer an employee at the company. Stakeholder pensions were introduced in 2001 as a simpler, more affordable personal pension option, aimed at low-income earners in particular. These pensions must adhere to a set of government guidelines. These include capping charges at 1.5% a year for the first 10 years. SIPs. One of the most popular types of personal pensions is the self-invested personal pension, SIP. SIPs offer more investment opportunities than most personal pensions, though charges are often higher. Contributors can build their own investment portfolio by investing in a wide range of assets, including listed shares of UK and overseas companies, unlisted shares, collective investments such as unit trusts, investments in trusts, insurance bonds, and real estate, but not residential property. Once the SIP is up and running, the pension holder can monitor investment assets and make changes to them depending on their performance. SIP providers differ in their choice of assets. Those offering the fullest array of options within HMRC guidelines are generally managed through a financial advisor. Retirement annuity contracts and buyout policies. Retirement annuity contracts and buyout policies are older types of pension funds, no longer open to new investors. Providers are obliged to pay out a minimum guaranteed sum. Buyout policies were introduced in the early 1980s, but later phased out on the 6th of April 1988, when personal pensions were introduced. Retirement annuities were launched in 1970, but also wound down in 1988 when personal pensions came onto the market. Tax relief and living abroad. Tax breaks on private pensions. Tax relief is given on contributions to private pension schemes. Contributors must ensure, however, that their scheme is registered with HMRC, as it will otherwise not be eligible for tax relief. In addition, the pension provider must invest according to HMRC's rules. Personal pension schemes must be registered with the Financial Conduct Authority, FCA, and Stakeholder Pensions with the pensions regulator. A private pension can usually be drawn on between the age of 60 and 65, depending on the provider. From the age of 55, up to 25% of the total fund may be withdrawn as a tax-free lump sum. Contributions to private pensions are tax-free for up to 100% of your earnings per year, up to £40,000 per year, up to $1 million over your lifetime. Tax allowances can be topped up with unused allowance from the previous 3 tax years. However, if money is withdrawn from the pension pot, the full tax allowance will be lost, usually dropping from £40,000 to £10,000. There are no restrictions on the number of pension funds that may be paid into, but the tax relief thresholds apply to the total contributions made to all funds. Retiring abroad. UK citizens living overseas can claim a pension within 4 months of retirement age, provided they have paid in the requisite national insurance contributions. The pension can be paid into an overseas bank account or a UK account. Retirees to the European Economic Area, Gibraltar, Switzerland, or a country with reciprocal social security rights will have a pension that continues to be index-linked, so it keeps pace with inflation. Retirees in countries that do not have reciprocal pension rights will have their payments frozen at the rate they were when they initially left the UK.